The end of fiat, how trillions in debt are fueling the next gold and silver boom. Have you ever considered the paradoxical nature of our modern economy, where decades of escalating debt have become the very foundation of our financial stability? We find ourselves at a fascinating and perilous juncture in history, a point where the sheer magnitude of sovereign debt has chained the hands of central bankers. The policies that were meant to stimulate growth and prevent collapse have woven a web so intricate that any attempt to return to monetary normalcy threatens to unravel the entire system. This isn't a theoretical exercise. It is the stark reality that defines the investment landscape today and for the foreseeable future, creating an environment ripe with both unprecedented risk and extraordinary opportunity for those who can see the writing on the wall. The core of the problem lies in a simple, unavoidable mathematical truth. After more than 4 decades of progressively easier money, the accumulation of debt at the governmental level has reached astronomical figures. We are now in a precarious situation where the fiscal balance of nations cannot be managed under a regime of normal interest rates. The cost of simply servicing the existing national debt at historically average rates would be so colossal that it would consume the federal budget, leaving precious little for defense, infrastructure, social programs, or anything else. This creates a trap from which there is no easy escape, forcing a fundamental shift in the relationship between governments, their currencies, and their creditors. This predicament effectively forces the hand of the Federal Reserve and its global counterparts. The long-cherished notion of central bank independence, while always partially a sham, is now being exposed as utterly subordinate to political and fiscal necessity. We are witnessing a moment where political influence is not just present, but is a driving force, compelling monetary policy in a singular direction. The pressure on central bankers to maintain low borrowing costs is immense, not for the sake of genuine economic growth, but for the survival of the government's balance sheet. This dynamic has set the stage for a new, permanent era of financial policy that will redefine the very concept of a safe asset. The inescapable conclusion and the central thesis for the coming years is that interest rates must, by necessity, be kept lower than the real rate of inflation. This policy, known as negative real interest rates, is no longer a temporary crisis measure, but a permanent feature of the macroeconomic landscape. The currency must be engineered to depreciate more quickly than the rate of interest paid on the debt, as this is the only politically palatable way to reduce the real value of the debt burden over time. If this delicate and destructive balance is not maintained, the entire financial edifice risks collapse under its own weight, making this policy the least catastrophic of a series of terrible options. This environment of engineered currency debasement is tremendously bullish for real, tangible assets that cannot be printed into oblivion. Gold and silver, the ultimate forms of sound money with millennia of history, are uniquely positioned to thrive. When savers and investors are actively punished for holding government bonds or cash, as their purchasing power is systematically eroded, they will inevitably seek refuge. Precious metals serve as the ultimate safe haven, not from market volatility, but from the deliberate and sustained policy of currency devaluation. This isn't speculation. It's a logical and historical response to the predictable actions of debt-laden governments. What makes the current moment so unique is the character of the precious metals bull market that has already begun. Historically, bull markets in gold were often driven by a frenzy of retail and institutional investment in the West, as investors panicked out of traditional assets. This time, however, the initial powerful surge has been fueled by a different, more formidable force. The primary buyers have not been the American public or European fund managers. They have been the central banks of emerging economies and savvy, large-scale investors across Asia. They are moving strategically, not out of panic, but in a calculated effort to de-dollarize and protect their national wealth from the very policies we've described. This stealth phase of the bull market presents a perfect storm for astute investors. The initial, most uncertain phase of the trend is over. The bull market is confirmed, validated by the actions of the world's largest and most informed financial players. Yet the Western markets have been conspicuously late to the party. The average investor, still conditioned to see stocks and bonds as the only viable options, remains largely on the sidelines. They see how far gold has moved and are hesitant, but as the reality of negative real rates becomes more apparent, they will be forced to participate. This sets the stage for a second, potentially more explosive phase of the rally. When these Western investors and traders finally awaken to the new reality, they will scramble to jump aboard a train that is already moving at speed. Human psychology dictates that they will seek out the assets that appear to have the most room to run, the ones that offer the most potential for rapid, outsized gains. This is where the true generational opportunity lies. They will look past gold itself and pour into the leveraged associated investments that have, until now, lagged significantly behind. This is the moment where silver and the mining stocks, long dormant and undervalued, are poised to experience a revaluation of historic proportions. For those looking to not just preserve but significantly grow their wealth, the current setup is near perfect. The foundational risk of being wrong about the primary trend has been largely removed by gold's established bull market. Yet the most high-powered, high-beta investments within the sector, namely silver and the equities of the companies that mine these metals, are still trading at or near long-term lows by many critical valuation metrics. It's a rare anomaly where the safe haven asset has already confirmed the thesis, while the investments that offer the most leverage to that thesis remain deeply discounted, offering a second chance to participate with explosive potential. When analyzing the precious metals market, it is crucial to differentiate between two fundamental reasons for ownership: insurance and investment. The first and most critical step for any individual, from the working family to the billionaire, is to secure their wealth through insurance. This is achieved by owning physical gold and silver. This act protects a portion of your wealth against the ongoing, relentless depreciation of the purchasing power of fiat currencies. This isn't a speculative bet. It is a defensive measure against a certainty of modern finance. Every currency in history has eventually lost its value, and ours are no exception. The concept of gold as insurance is often misunderstood. Unlike your home or car insurance, where you are protecting against a low-probability event like a fire or an accident, precious metals are insurance against a 100% certain event. You know with absolute certainty that the dollars, euros, or yen you hold today will purchase significantly less in 3, 5, or 10 years. By converting a portion of that currency into physical gold and silver, you are locking in today's purchasing power, effectively taking that wealth off a melting ice cube and placing it into a permanent, indestructible store of value that has protected humanity for centuries. This perspective transforms the act of buying gold from a market speculation into a fundamental act of financial prudence. It's not about hoping the price goes up. It's about guaranteeing that your accumulated savings are not stealthily confiscated through the hidden tax of inflation. There is no possibility that you will not eventually need this insurance. The policies of central banks guarantee its necessity. This makes a core position in physical metals the non-negotiable foundation of any sound, long-term financial strategy in the current economic environment. It is the bedrock upon which all other investment and speculative activities should be built. Once this foundation of insurance is firmly in place, one can then turn to the second reason to own precious metals: investment for substantial gain. This involves taking a portion of your more speculative capital and allocating it to assets that provide leverage to the rising price of the underlying metals. This is where the mining stocks come into play. These are publicly traded companies engaged in the exploration, development, and operation of gold and silver mines. While they carry more risk than the physical metal, they also offer the potential for returns that can be multiples of the gains seen in gold and silver themselves during a bull market. However, navigating the world of mining stocks is a perilous endeavor for the uninitiated. It is not an area for casual, willy-nilly investment. As the saying goes, investing is a team sport, and in this highly specialized sector, that wisdom is paramount. Success requires a deep understanding of geology, engineering, corporate finance, and geopolitics. You are not just investing in a hole in the ground. You are investing in the management team's ability to execute a complex and capital-intensive business plan. This is why aligning yourself with professional guidance and research from seasoned experts is not a luxury, but a necessity for survival and success. Without expert analysis, the average investor is likely to fall prey to common pitfalls, such as investing in companies with flawed projects, incompetent management, or unstable political jurisdictions. A professional newsletter or analyst provides the crucial due diligence, separating the legitimate, high-potential opportunities from the countless ventures destined for failure. This guidance dramatically increases the probability of not only achieving significant wins, but also avoiding catastrophic losses. It provides the essential information needed to analyze geological claims, mine viability, balance sheets, and the track record of the leadership teams who are the ultimate stewards of your capital. The historical context for this opportunity is striking. The last time we saw a setup this compelling was in the early 2000s. Between 1999 and 2001, gold and silver hit a double bottom, marking the end of a brutal two-decade bear market. At that time, both the metals and the mining stocks were completely bombed out, trading at multi-decade lows and despised by the mainstream financial world. It required immense courage and foresight to invest in the sector back then, but those who did were rewarded with life-changing gains as the new bull market took off and ran for the next decade. Today's opportunity is both similar in potential and unique in its nature. It is in many ways an even more favorable setup. Back in the early 2000s, investors had to bet that a new bull market was beginning. Today, that question has been answered. The bull market is already underway, confirmed by gold's strong performance. The risk factor has been significantly reduced. And yet, the most potent, leveraged segments of the sector remain at valuations reminiscent of that 2001 bottom. This allows investors to participate with the confidence that the primary trend is in their favor, a luxury that was not available 2 decades ago. The severe underperformance of mining stocks relative to gold is a key anomaly that signals the scale of the opportunity. A useful metric for this is the Hui index, an index of major gold mining companies divided by the price of gold. For over a decade, this ratio has been in a grinding downtrend, indicating that mining stocks have consistently underperformed the very metal they produce. This trend has been a source of immense frustration for investors in the sector, but there are now clear technical signs that this long-term downtrend is on the verge of a historic breakout, signaling a major reversal is at hand. When this trend finally reverses, the catch-up rally could be breathtaking. It is important to understand the mechanics of leverage within the mining sector. A mining company has relatively fixed costs of production. Once the price of gold rises above that all-in sustaining cost, every additional dollar increase in the gold price flows almost directly to the bottom line, causing profits to expand exponentially. For example, a 20% increase in the price of gold could easily lead to a 100% or 200% increase in a miner's net income, which in turn can send its stock price soaring. What makes the current situation even more explosive is that, even with today's gold prices, many well-run mining companies are already generating enormous profits. They are enjoying profit margins that have rarely, if ever, been seen in the history of the industry. Yet despite these robust earnings and massive cash flows, their stock prices continue to lag, trading at incredibly low multiples of their net asset value or price-to-earnings ratios. This disconnect between fundamental reality and market valuation is unsustainable and represents the core of the current investment thesis. The market has not yet priced in the profitability of the present, let alone the potential of a higher gold price in the future. Silver represents another, more direct form of leverage to gold. Often called poor man's gold, silver has a dual nature as both a monetary metal and an industrial commodity. Historically, in precious metals bull markets, silver tends to lag gold in the initial stages but then outperforms dramatically in the later, more speculative phases. The gold-to-silver ratio, which tracks how many ounces of silver it takes to buy 1 ounce of gold, is a key indicator of relative value. When this ratio is high, as it has been recently, it suggests that silver is deeply undervalued relative to gold and has significant room to run. The divergence of silver from both gold and the broader inflation narrative is stark. When adjusted for inflation, the price of silver is nowhere near its former highs, suggesting it is profoundly undervalued from a historical perspective. As investors increasingly seek out hard assets to protect against inflation, silver's relative cheapness will make it an attractive option. Furthermore, its critical role in modern technology, including solar panels, electric vehicles, and electronics, provides a strong and growing industrial demand base that underpins its value, separate from its monetary characteristics. This combination of factors makes silver a coiled spring, ready to unleash tremendous energy. This isn't merely a cyclical bull market we are discussing. It is potentially the culmination of a secular 50-year trend. We may be witnessing the final stages of the grand monetary experiment that began in 1971, when President Nixon severed the last link between the U.S. dollar and gold, ushering in the age of purely fiat currencies for the entire world. This system, based on debt and confidence alone, has reached its mathematical and logical limits. The end of such a long-term cycle is not a gentle process. It involves a chaotic and dramatic reordering of the global financial system. If this larger thesis is correct, then the gains we are anticipating will not be a mere repeat of the 1970s or the 2000s. They could be the largest and most significant in modern history. When a global reserve currency system comes to an end, the transfer of wealth that occurs is immense and unforgiving. It is a moment where the distinction between winners and losers becomes brutally clear. Those who hold wealth in depreciating paper assets will see their purchasing power evaporate, while those who have positioned themselves in timeless, real assets will not only preserve their wealth but see it magnified to an extraordinary degree. The people who stand to lose the most are those who have followed conventional financial advice: savers, pensioners, and anyone holding long-term bonds or cash-based assets. Their prudence will be punished, as the real value of their savings is systematically destroyed by inflation and negative real rates. Conversely, the winners will be those who understood the endgame and positioned themselves accordingly. The potential for gain is commensurate with the potential for loss. In the end of a fiat currency regime, wealth is not destroyed. It is simply transferred from those who hold paper to those who hold real assets. The fight for sound money has a long and storied history, championed by individuals who understood the deep connection between economic liberty and honest money. One such figure was Jim Blanchard, who in the early 1970s launched a crusade to restore the right of private gold ownership to American citizens. His efforts, including flying a legalized gold banner over President Nixon's inauguration and daring the Treasury to arrest him for publicly brandishing bullion, were instrumental in the law change that took effect in 1975, allowing Americans to once again invest in gold. Blanchard's fierce dedication to personal liberty highlights a timeless principle: control over money is control over people. An unsound, inflationary monetary system is a tool of subtle confiscation and control by the state. The movement he started was about more than just an investment. It was a philosophical battle for the right of individuals to protect their property and their freedom from the debasement of currency. This legacy of education and advocacy continues today, seeking to empower people with the knowledge to navigate a financial system that is increasingly hostile to savers. That historical struggle for sound money is more relevant today than ever. We are once again at a point where the stability of our money is in question, not because of a specific law, but because of the systemic insolvency created by decades of fiscal profligacy. The principles that Blanchard fought for are the very principles that offer a lifeboat in the current storm. Understanding that real wealth is not measured in currency units, but in tangible assets that hold their purchasing power over time, is the most critical piece of financial wisdom one can possess in the 21st century. To truly grasp the long-term value of this perspective, one can look at major assets priced not in dollars, but in gold. Websites and charts that perform this calculation reveal a stunning truth. When measured in real money, many of our vaunted financial assets have made little to no progress over vast stretches of time. The S&P 500, for example, priced in gold, is trading at levels comparable to those seen in the 1930s or 1970s. This demonstrates that much of the nominal gains seen in stock markets are simply a monetary illusion, a reflection of the dollar's declining value rather than a true increase in underlying worth. This brings us to the ultimate duality of gold. It is both the ultimate defensive asset and, during specific moments in history, the asset with the single greatest potential for gains in real purchasing power. We appear to be entering one of those rare moments, akin to 1934, the 1970s, and the early 2000s. It is a period where the safe haven asset also becomes the highest performing growth asset. The confluence of an inescapable debt trap, the forced implementation of negative real rates, and the profound undervaluation of the leveraged plays in silver and mining stocks is not just an opportunity. It is the defining financial event of our generation.